I think this dip has a lot to do with Bitcoin's weird relationship with software technology. And I actually think that this dip is going to be really healthy for Bitcoin in the long term, because inevitably, at some point, we're going to have to resolve of the fact that Bitcoin is trading like a tech stock, and it's not a tech stock. It's the best money in human history. And so at some point, we're going to have to grow out of that as an asset class, and we're going to have to mature through that. And I actually think that that might be happening right now, and albeit painful, absolutely necessary. Every dip is good for the longer cause of Bitcoin becoming the best money of all time.
Jack Mallers has just revealed a simple but uncomfortable observation. Bitcoin is still being traded like a technology stock, and that mismatch is at the heart of the current drawdown. From Mallers' perspective, this correction is not random, nor is it purely sentiment-driven. It is a direct consequence of how Bitcoin has been positioned within global portfolios. Despite its monetary properties, Bitcoin remains grouped with software and high-growth technology assets. When capital exits that category, Bitcoin gets pulled along with it. This creates a paradox. Bitcoin is often described as digital gold, yet it has shown almost no correlation with gold over time. Instead, its strongest correlation has been with software equities. That correlation is not philosophical. It reflects ownership. The same pools of capital that hold software stocks also hold Bitcoin, and when those portfolios are forced to de-risk, Bitcoin becomes a source of liquidity. Mallers argues that this phase, while painful, is necessary. Markets mature through repricing events. Bitcoin cannot fully assume its role as a monetary asset until it stops being treated as a speculative technology trade. In that sense, this drawdown is not a rejection of Bitcoin's thesis, but part of the process of resolving a long-standing misclassification. To understand what happens next, it's important to look beyond price action and examine where liquidity is moving, why software is under pressure, and why Bitcoin is being affected despite its fundamentally different role. If you find this type of macro-driven crypto analysis useful, consider liking the video and subscribing. Let's break down the mechanics behind this shift.
Chapter 1. Bitcoin isn't trading like gold, it's trading like software. We've talked about this before. Bitcoin's correlation to gold is 0.09, meaning effectively zero correlation. They've never moved at the same time. But what Bitcoin does seem to be highly correlated with, and what it is trading like, is software technology stocks. So, first of all, why is Bitcoin dumping? What are people missing? I'm here to make the case that, liquidity, I call it relocating. And we'll dig into what that means and why. But a lot of the capital, at least in the United States, but also globally, is leaving software. Okay, software is going from being an extremely cash-abundant, cash-producing asset, and it's becoming really capital-intensive. And for that reason, capital is leaving software. It's not this cash machine anymore. In fact, the capex of these companies is going through the roof. You combine that with the fact that the United States of America is trying to incentivize capital to invest more domestically in infrastructure, in energy, in power, in critical minerals, in defense, and less in these really frothy tech multiples that have created this massive wealth gap. The Trump administration has talked about Main Street over Wall Street. Now, whether that's true or not, whether you believe them or not, it doesn't really matter. The point is the Biden administration and the Trump administration, the left and the right, the blue and the red, the Democrat, the Republican, they're trying to do the same thing. They're trying to unwind from the post-$71, from the US dollar as the world reserve currency. They're trying to build back US defense capabilities, US infrastructure capabilities, manufacturing capabilities, build back the middle class. That is unequivocally what the United States is trying to do. They have realized that they have an issue. They have realized they've hollowed out their middle class, hollowed out their defense base, hollowed out their manufacturing base, and it's caused such a problem, such a reliance on China, political instability in the country, things like drug overdose, things like suicide rates, things like obesity rates, metabolic disease, assassination attempts rivaling the Civil War, all of the problems that signal a collapsing empire, okay? The other thing is just, it's very obvious where the liquidity is going, as I just said. It's going to CapEx, it's going to energy, it's going to industry, it's going to defense, it's going to critical minerals, it's going to all the things I just referenced. The interesting thing that we'll talk about on the show is why the hell does that mean Bitcoin has to take a clobbering? right? To me, that's kind of what I figured the most valuable thing I can do for the episode today is walk you guys through, well, why is Bitcoin caught in the middle of all that? Bitcoin's supposed to be like gold. Bitcoin's a hard asset. Why is Bitcoin getting clobbered like software as that's rotating into critical minerals? That doesn't make any sense. Okay, well, first of all, a picture's worth 1,000 words. So for those watching, in the orange is the Bitcoin price. In the white is the software ETF. So software stock ETFs. And the point is they're one for one. They're moving the exact same. And this is from 2025 up until today. So this is not over the last few days, few weeks, few months. This is over the last year. Okay. For those listening, I think I just described it, but I know a lot of you guys are listening and not watching on YouTube. The correlation between, which I'll show in a second, tech and Bitcoin is above 0.8, where one is directly correlated. They move to the pixel the same. Importantly, what does this mean? Correlation, specifically in this instance as well, tells us who owns these assets, tells us the asset owners are the same. So the point that I need you guys to understand is despite us Bitcoiners, this little nerdy corner of the internet that is finding themselves listening to me live every Monday, we know and we hold Bitcoin as hard money. Take me as an example. I work for Bitcoin. My paychecks get swept into Bitcoin. I save in Bitcoin. Bitcoin to me is not a software tech stock. Bitcoin to me, I'm monetizing Bitcoin. I'm using it to save. I'm using it to then later exchange for the things I need in my life. So I'm using Bitcoin as hard money, as hard asset. Okay, I'm monetizing it. Now, what about other people? What about the broader market? The broader market, unfortunately, has viewed Bitcoin as monetary software, like a software stock. And you can see this now in the correlation of the software ETF and Bitcoin. As software has gotten clobbered, that means software is deleveraging. That means people are taking capital out and rotating it into other things. Bitcoin has gotten clumped into that. So this is very obvious proof that a decent chunk of Bitcoin holders, a non-zero, a material chunk of Bitcoin holders have historically also been these software holders, okay? So despite how much we want to believe it on our corner of the internet that Bitcoin is held by hodlers of last resort and we all are never going to sell and we're all like Michael Saylor, this correlation chart shows that that's not necessarily true. And to be honest, I actually started to notice this pattern about 10 years ago. The run-up in 2017, we started to see a lot newer entrants. These were levered hedge funds, levered funds. That was when, I wouldn't say Wall Street, like today Wall Street's Larry Fink and all BlackRock and all these guys. Not that Wall Street, but fast money Wall Street. Day traders, levered funds, long-only positions. That's when I started to see these guys show up. So this is not recent. People will say, oh, this is since the ETFs. No. This is a product of the system, of policy. When you print so much money, and, as we've talked about, the coasts of America benefit tremendously from what has been monetary policy in the United States over the last 40 years. They go in and they punt software, and software has these crazy multiples. Bitcoin's got this crazy volatility, so on and so forth. So back to the liquidity rotation we're living through. Okay. Liquidity is leaving software, equities that are dependent on buybacks. So a lot of the premium that was placed on stocks like Amazon is because Amazon would take the immense amount of cash profit they were producing and they would buy back the equity. And so the premium is justified because they are buying the asset that they're creating demand with their cash flow, with the asset that I own. It's rotating out of momentum and leverage. So things are delevering tremendously. And the overall structure of the market structure is changing. We're slowly shifting out of these passive flows. Liquidity is finding itself into new CapEx. So we'll get into in a second, all of these massive big tech companies are spending hundreds of billions of dollars a year on infrastructure. It's going into energy, industrials, critical minerals, infrastructure, what people on TV call the real economy.
Maller's core argument centers on liquidity rotation. Over the past decade, software companies were defined by low capital requirements, high margins, and abundant free cash flow. That cash was frequently returned to shareholders through buybacks, supporting elevated valuations and reinforcing momentum-based investing. Bitcoin, due to its volatility and speculative appeal, became embedded in the same capital cycle. That environment is now changing. Capital is moving away from asset-light, high-multiple software businesses and toward sectors that require real investment: energy, infrastructure, industrial production, defense, and critical minerals. This shift is not ideological. It reflects structural realities facing the United States and the global economy. Bitcoin becomes collateral damage in this transition because it is still perceived, by much of the market, as a form of monetary software rather than as a neutral, hard asset. When software portfolios deleverage, Bitcoin is sold alongside them. The correlation data Mallers highlights makes this relationship explicit. Bitcoin and software ETFs have moved almost in lockstep over the past year. This does not mean Bitcoin is failing. It means Bitcoin is being repriced within a shifting market structure.
Why is software taking a beating? We have to understand from a macro standpoint. I'm going to be a little bit rhetorical here, but we got to nail this point. One, the most important point, the biggest catalyst to what's happening is AI. AI is changing the economic profile of these software companies, meaning these software companies are going from companies that are producing massive record-breaking amounts of cash, okay? Meta, Microsoft, Amazon, Google, like these companies are, they're historically known for being the most profitable things to ever exist in the course of mankind, okay? They have now turned into insanely capitally intensive businesses. They're forward projecting, like you're seeing their earnings calls and it's like Amazon CapEx changed from 100 billion to 200 billion, doubling their cap expenditures. The second reason is structural to the United States. As I've said, the United States has exported the dollar, exported their jobs, exported their manufacturing base, exported their defense base. Being the world reserve currency, doing no proof of work, the last 20 to 40 years has entirely eroded the country. And that's not a political statement. That is a left, right, blue, red, Biden, Trump. Doesn't matter how you slice it. We have all the characteristics of a falling and collapsing empire, and Washington, D.C. is trying to fix it. One of the ways they're trying to fix it is redirect all of this capital into places that benefit the country's agenda. The country's agenda are reindustrialize, build back a manufacturing base, bring blue-collar jobs back, bring back our defense base, reduce our reliance on China, hoard our own critical minerals, etc., etc., etc. Drastically reduce the U.S. dollar's role as the world reserve currency. Okay, weaken the dollar. Neutral assets go up. All of these things. The combination of these two results in software getting its ass kicked. If these software companies are not immensely profitable cash machines, which then take the cash and give it back to shareholders in what we call stock buybacks, they don't literally pay out dividends, but they just take the cash, buy the stock goes up. That's why you own the stock. The combination of that and the United States' agenda and where we are in this fourth turning and, regime change globally, big tech software is changing. Highly levered, high time preference software stock punters are getting destroyed. And that liquidity is rotating, okay? So chapter 2 is how AI changes the economics of software. So this all started to really exaggerate and get intense when this Anthropic model came out recently. So this CNN title, Anthropic's new AI tool sends shudders through software stocks. This was published February 4th. Stocks slumped on Tuesday amid nerves about AI disrupting the software industry. And then we all know what happened last week. After stocks started to tumble, leverage beats up leverage, which beats up leverage, which beats up leverage, and you get these cascading effects where a simple downward move of liquidity getting punished and leverage getting punished cascades on itself, and before you know it, Bitcoin's down 25%. It's important to note, and this is a small nuance, but I think it's important. It's not like, because people will say, Jack, you're being hyperbolic. Facebook, Meta's not dying as a company. Google's not dying as a company. I'm not saying that, because you guys need to take, my thoughts as they are, and they're realistic and they're practical, okay? It's not killing software companies, it's killing the premium, okay? So much of the liquidity was going into these companies trading at 50 to 100 times multiples, like Tesla. Tesla trades at an insane multiple. You'll never get paid back if you were to buy that business at its market cap value, okay? It's killing the premium. The premium is no longer justified, okay? Because the old software model was that these businesses were light on assets. They didn't have very large CapEx. It didn't require a lot of investment to run them. Extremely high margins, and they could do buybacks. They had so much cash. So high scale, high TAM, high margins, asset light businesses, okay? Now, in the AI world, that's all changed. They are high compute, high data center, high spend, high power, high chip businesses. There's not that much cash left over. In fact, many of them are spending more than they earn. Google just had a 100-year bond sale today. So the point is, when you go from very cash rich and a liquidity profile in the 2010s where it's just print money, print money, print money, assets, 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 tech, 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 and that's changing. So this headline from CNBC, tech AI spend may be approaching $700 billion this year, but the blow to cash raises red flags. Again, that's my point. They are now spending insane amounts of money, and the red flags raised are the fact that it's going to eat into their cash flow. CapEx number go up. This is big tech's CapEx growth. In Q1 of 2023, they spent a little over $100 billion combined. They are approaching $1 trillion projected this year. That is absolutely insane. This is, again, guys, this is not a trend. This is not a fad. This is a factual regime change we are living through. Another eye-watering CapEx number, Amazon sees 2026 CapEx about $200 billion. That is well above their estimated $146 billion. Holy moly. Wild stat of the day. Amazon has spent more on CapEx in the last 3 years than in the previous 26 years combined. Regime change, guys. AI is changing things. The world is changing. The US dollar as the world reserve currency is fundamentally changing. We are living through, whatever you want to call it, a fourth turning, whatever you want to call it. The change is absolutely real.
The second half of Mahler's analysis focuses on what changed structurally and why this shift is unlikely to reverse quickly. Artificial intelligence has transformed the economics of software. Companies once known for extraordinary profitability are now committing hundreds of billions of dollars to data centers, chips, energy, and infrastructure. Software is no longer capital light. Margins are being pressured, free cash flow is shrinking, and the valuation premiums that defined the last cycle are being reassessed. This process does not destroy software businesses, but it does compress their multiples. When leverage is layered on top of that repricing, market moves accelerate. Bitcoin, still embedded in these portfolios, experiences amplified drawdowns as capital exits the broader risk tech complex. At the same time, the macro backdrop reinforces this shift. The United States is attempting to reduce its reliance on financial abstractions and rebuild tangible capacity. In such environments, assets tied to proof of work, scarcity, and physical constraints tend to regain relevance. Importantly, this correction has also clarified who actually drives the crypto market. As Matt Hougan recently wrote, "I visited a bunch of financial advisors this week and can confirm they're still generally bullish. Those who haven't invested yet see the pullback as an opportunity, and those who bought earlier plan to hold." That said, if there is one thing this pullback has taught us, it's that ETF investors are not in charge. crypto-native investors still dominate the market. We spent too much of the past year thinking about the marginal buyer, the ETF investor, and not about the marginal hodler, the crypto-native investor. This distinction matters. ETFs expanded access to Bitcoin, but they did not replace native market participants. During periods of stress, long-term holders still determine market structure and downside resilience. That helps explain why volatility remains high, but also why conviction among experienced participants has not disappeared. Hugin expands on this view by emphasizing that crypto markets are narrative-driven. Looking ahead, he identifies multiple emerging narratives that could shape the next cycle, including revenue-generating blockchains, AI-driven financial applications, fading confidence in fiat currencies, long-term institutional adoption, regulatory clarity, stablecoin growth, tokenization, renewed DeFi innovation, and a renewed focus on Ethereum's development. The takeaway is not that any single narrative guarantees higher prices. It is that the underlying transformation of the crypto ecosystem continues, even as prices correct. Taken together, Maller's analysis and Hugin's perspective point to the same conclusion. This drawdown reflects a regime shift, not a thesis failure. Bitcoin is being repriced as capital rotates, leverage unwinds, and markets reassess what is truly scarce and durable. When this phase ends, whether months or longer, Bitcoin's role is likely to look less like speculative software and more like what it was designed to be, a neutral, hard monetary asset emerging from a period of structural realignment.